how you think politics are going to play out in economic and investment terms in the U.S.
Well, I actually, somebody was asking me yesterday, what do you think is going to happen in the election? I think it's a long time before next November with these two candidates. It's always a long time, and in particular, this situation, I think there's a lot up in the air.
I mean, do you feel that we're due a kind of correction to maybe a more normal investment climate after several years of there being a little bit of I mean, it's not just volatility, but it's unpredictability.
I mean, I think let's start with interest rates, because I think that's been a big part of people's question. I tend to think that the market is optimistic in their view that rates are going to be cut 100 basis points next year. I think that, we've had, in the U.S., you have had basically the Fed coming and constantly rescuing us every time. And I think now Chairman Powell, you've heard it before, he doesn't want to be an Arthur Burns, he wants to be a Volcker. And I think if you look at the underlying numbers, why core inflation was looking better, super core, which now he's talking about super core, was not looking as good. And so, I think the good news is we're probably to peak rates, probably don't have another increase, but I don't know that they come down as quickly. And I think the second piece of that, which I don't think gets enough coverage, is, and our prior speaker just talked a lot about debt. You look at the U.S. debt, it's gone from $9 trillion in 2007 to $31 trillion this year. And we're going to add $2 trillion more from the deficit from this current budget, this current year. And so you need buyers of that. And the largest foreign buyer of U.S. debt today, of treasuries, is Japan at $1.1 trillion. I don't think they're increasing it. Second is China at $850 billion. I don't think they're increasing it. And so, the rates are going to have to stay high enough to attract capital. I think the U.S. is still the reserve currency. I don't think it's going to have a problem attracting capital. It's just at what rate does it attract that capital? And I think that has a little bit of a drag.
So if we sort of step back and look at your role at Franklin Templeton over the last 3.5 years, and the title of this panel is Old Rules versus New Rules. I'm not sure exactly what the old rules were, but certainly for the new rules and what you've done with the company is look at both traditional investment but also some of the new asset classes and where the Franklin Templeton needs to move into, which areas to ensure access to some of those new assets for investors, as well as shoring up your traditional areas as well. I mean, is it a mix of old and new, essentially, that you're having to chart?
Yeah, so we've done 10 acquisitions. We're just about to close our 10th in the last 3 years, and they've been focused on two areas that we think are big secular trends in the industry. One is private markets, and the second is customization, and so technology and things to help customize. So let's talk about the private markets. I saw BCG, their wealth study from last year, predicts by 2027, private markets will account for about 22% of AUM in the asset management industry and 56% of the revenues, right? So you look at that and you say, well, all right, from just a margin standpoint, you have to be in that space. And then, there's a question, well, were these private markets fueled just by this artificially low interest rate environment? Take private credit. I don't see banks continuing to step back in and lend like they ever lent before. The capital requirements are such post-08. What's happening in the reaction to the Silicon Valley Bank blow-up, you are not seeing banks want to lend. They can't lend because capital is so expensive, and so you've created this massive proliferation of private credit. And it's continuing to take a bigger share of the market. So I think that's kind of a permanent secular trend. We bought Benefit Street Partners and Alcentra, so we have about $78 billion in private credit. And then the second area in private equity, yes, I do think it was fueled by lower rates, and it's going to be harder for managers. But the fact is, people don't want to go public in the U.S. in the same way. It's easier to be private. Why is it easier to be private? And you see it in the numbers. In 2000, granted a bit of an anomaly, companies went public after 3 years. By 2019, they were going public 9 to 10 years. By 2022, that was 14 to 15 years. So all that early growth is now captured in the private markets. So if your PE strategy was based on leverage, it's going to be harder. But if it was based on restructuring, and as long as the capital's there, I think companies are going to stay private longer because you need to invest in technological advances. You need to, and the pressure on quarterly earnings are such that I think that in times of this great disruption, when you should be investing, it's harder to do when you're public. Not to mention just kind of the pressure that I think that the difference pressure of a public company CEO versus private company CEO. So we looked at that and said, okay, this is a space we need to be in. And so we bought Lexington Partners, which is secondary PE. We have Clarion Partners, which is real estate. So we're about $260 billion in private markets. And then, as I mentioned, customization. I always say, what does Franklin Templeton do? Our expertise is in making active investment, risk-adjusted investment decisions. We want to deliver it in whatever vehicle our clients want to receive it in. And what's happening is technology is enabling you to create like separately managed accounts that not only have the investment mandate that the client's looking for, but can overlay objectives like, sustainable investments. Let me overweight sustainable companies. So you're able to customize it much more to individual clients. And we think that trend is here to stay.
And does that extend to digital assets in terms of demand as well as your interest?
So I'm a huge fan of digital assets. You got to get me started in a small. So why do I love blockchain? And I always say that Bitcoin is the greatest distraction from the greatest disruption. I'll put AI as also a great disruptor. And my favorite example of why I love digital assets, because you're going to be able to unlock investments that you never could have access to in the past unless you're a big institution. So blockchain does three things. It has a payment mechanism. It has smart contracts that can execute without anybody being involved. And it has a general ledger, which means if I own the token in my wallet, I have all the rights of that token. So my favorite example is the singer Rihanna, who came out with 300 NFTs, each worth 0.00033% royalties to one of her songs. Now, she was just kind of testing the market, but why can she do that? She can do it because when a streaming service plays her song, the smart contract can execute and say, Mustafa has the rights. He's a huge Rihanna fan. He's holding that token. It executes and has a payment mechanism to pay him, and there's no third parties involved, so you can have fractions of cents that actually go and register. So if you think about it, and you're already seeing in the digital asset space interesting types of investment opportunities. There's a company today that is going out and buying up the image rights on social media of new college athletes, star athletes, betting on which ones are going to be professional. And so you can own a pool of the potential, right? That'd be something you'd never be able to own. And if you didn't have this ability with the technology, you wouldn't have been able to do it. So I think from an asset manager, it's going to be a really interesting way for us to deliver new uncorrelated investment capabilities.
So you still see there's a role for an institution like Franklin Templeton in that new era. It's not a peer-to-peer situation.
I think the role, and the interesting thing is the portfolio manager of the future who's going to be in that space, again, it's an active decision, is going to be somebody who understands an athlete and sports and who's going to pick the best players who they think are going to be very successful in pro versus college, or royalties and singers, getting into early. So I think that again, it's still an active investment decision, but the skill set's going to change. Now, you're still going to have all the traditional types of investments that we have, but it's just going to expand it more.
And you talk about these innovations, and very much they're coming out of the United States, but you've been on a kind of mini tour these past weeks. You've been to Hong Kong, you've been to Saudi Arabia, and now in Abu Dhabi. It feels as if the regulatory environment outside of the US in these, what we might call emerging markets, are more helpful to an institution like yours than perhaps US regulatory environment. How are you finding the experience of what you're seeing in these places?
First of all, there's a very simple rule, which is capital goes where it's treated well. And one of the very important criteria in that is what is the regulatory environment. And so in the case of digital assets, we actually have we had the first 40 Act mutual fund approved by the SEC, so a money market fund. Unfortunately, the regulation in the U.S. hasn't really evolved much beyond that. And part of that is because it's not clear who's responsible for regulating. So we are looking, and the UAE has actually been very progressive in the regulation that they've come out. So we're working with a partner here on doing some interesting things. So I think the places that have the most clarity on digital assets are the UAE and Hong Kong. Singapore it's very interesting. They are approaching it by bringing in a lot of partners, and so they have a lot of pilot programs that are the regulators involved in watching so that they can then build the regulation after they've done some testing around it. So I would say the UAE and Hong Kong have said, let's give clarity and we'll come out with the rules, whereas a place like Singapore is very supportive, but kind of blending it along with the pilot programs that are there.
And I think there was a time when asset managers could remain in New York or wherever and have a proper view of what was happening in the markets. But now do you feel you have to get out there?
Listen, we acquired Templeton in 1992. You know, listen, our view has always been you have to be in a local market, speaking the local language, reading the local papers, understanding the community there. And so, you know, from an investment standpoint, it's important. From a relationship standpoint, to really understand your client's needs, you got to be local. And you know, that's why I think we investment feet on the ground in something like 87% of the world's GDP. We have in you know, offices global. We've been in this country for 22 years. We actually acquired a local asset manager. We have, you know, we manage $4 billion out of this office in GCC bonds. Being local, we think, is really important. It's part of our DNA. Others have a different approach.
I mean, there was a time when emerging markets were really fashionable, and everyone wanted to be in them, and everyone wanted to be looking at them, and then we've kind of gone away a little bit from that. Is that coming back in your view?
Well, I think if you hit peak interest rates, you'll start, and you've already seen it. And again, maybe it's a little bit overdone at the moment, but the dollar tends to weaken once you hit peak rates. So I think that benefits emerging markets. I do think this China +1 strategy, you're going to have real winners. You know, you look at it, I mean, we look at it and think places like in Indonesia, Philippines, India, you're seeing Foxconn just was talking about their $1.5 billion investment in India. You know, you're going to see opportunities, I think, in emerging markets. And I think one of the things that's held it back a little bit, obviously in this region, they almost sit in between. Price of oil is obviously a great benefit to the region, but also they sit between China and the U.S. And you know there needs to be. I don't know that the last APEC in San Francisco created sort of a floor and maybe reconnection between China and the U.S. But I don't think it has repaired the relationship. I think there's always going to be competition there, and there'll be opportunities for people to play in between that. And so I think you look at some of the trends, and I think that emerging markets, now that the dollar has or rates have primarily been, you know, you probably hit the peak. It's a good time to be back in it.
And I think if I wrap with this to get more of a personal view from you in terms of the role of a chief executive these days, with, as you mentioned, AI coming and we have many different trends, but it seems to me that a CEO now has to be much more than just somebody who kind of leads people internally. And you have to wear kind of two hats. One way, you're engaging with the world around you in a much more deeper way, but also helping those within the company understand some of those wider trends. When you looked at this role, when you first went in 3.5 years ago compared to now, what's kind of surprised you most in terms of what you've needed to do?
I'll tell you what I think a lot about. So I'm third generation at Franklin Templeton. Not only rarely do things make it to the fourth generation, but in times of great technological disruption, and we are living in that right now, rarely do the incumbent companies make it, because incumbents tend to just improve and make more efficient what you do and not disrupt. And so to me, It's being able to have the right team around me and I try to commit 30% of my time to disruption. So I sit there with the AI team, say, tell me, what are we doing? Are we doing enough pilots? I spent a lot of time on the digital assets and blockchain, but you have to have the right team there to be able to spend that time.
Jenny Johnson, thank you so much for being with us. Thank you.